18 dividend ETFs sit in the corner of the market that almost nobody talks about. One of them has raised its dividend every single year for 67 consecutive years, and most investors have never heard the ticker. Another one returned about 13.9% annualized over the last decade, beating the fund every YouTube channel keeps shouting about. And one of these 18 has a track record so strict it required every holding to grow its dividend through 1987, 2008, 2020, and 2022. Without a single year. I have spent the last 8 years building a portfolio out of the quiet funds nobody links in dividend comment sections because the loud ones cost me real money first. By the end of this video, you will know exactly which 6 of these 18 dividend ETFs are actually worth owning, which 6 are dead weight, and which 6 are dangerous in disguise. The quiet ones are not boring. The quiet ones are the entire point. Here is the promise. I ranked all 18 by 3 rules and only 6 survived. Rule 1, the 10-year annualized total return had to come within 200 basis points of SEHD or beat it outright, because the whole point of a low-profile fund is that it should reward you for sitting through the silence. Rule 2, the expense ratio had to come in at or under 40 basis points, because nothing eats a portfolio faster than an unnoticed fee. And Rule 3, the fund had to have more than $200 million in assets under management, because illiquid funds get delisted without ceremony, and the last thing you want is to be the last person left in a small fund when the wind shifts. I excluded the 4 funds the channel has tier banned, which are SPHD, FDVV, SDY, and IDVY, because we have made the case for that ban in earlier videos and nothing in 2026 has changed our mind. I excluded STHD itself, because STHD has its own gravitational pull now, and you do not need another video that ends with the same 3 letters. We will cover SEHD in the very next video in detail, so do not worry about the omission here. None of this is financial advice. Past performance does not guarantee future results. And a fund that compounded for a decade is not the same thing as a fund that will compound for the next one. The legal disclaimer matters here because the strict 10-year filter we are about to apply is a historical look back, not a forecast, and a fund that passed the filter on the way up can absolutely fail it on the way down. Harry, the friend I keep dragging into every video, started doing exactly this exercise 3 years ago, and he is the reason I built the list this way. He had been holding the loud funds for a decade, and he wanted to know what he had missed. The answer turned out to be larger than he expected and more expensive to ignore. He had paid for the marketing budgets of the loud funds 3 times over before he ever asked the question. We split the 18 into 3 chapters. The foundational 6 are the funds you have probably heard of but do not own. The hidden 6 are the funds the financial media has buried under a pile of SEHD comparisons. And the specialty 6 are the funds that do something different enough that they belong in their own conversation. The climactic pick at item 18 is the answer to the question, if you only own one of these 18 funds, which one? Stick to the end, because that answer is the entire point of this video. Chapter 1. The foundational 6. These are the funds with the most assets, the longest track records, and the worst case for being called undiscovered. You have heard the tickers. The reason they belong on this list is that hearing a ticker and owning a ticker are 2 very different things, and the data shows almost nobody in the dividend community actually owns them. They sit there compounding without ceremony, while the loud funds get the airtime. Item number 1, VYM, the Vanguard High Dividend Yield ETF. It launched in November of 2006, which means it has 18 full years of market history, including the 2008 collapse, the 2020 crash, and the 2020 rate shock. It currently holds around $73 billion in assets, which makes it one of the largest dividend funds on the planet, and yet you almost never hear a creator recommend it standalone. The trailing yield sits in the 2.2 to 2.4% range. The expense ratio is 6 basis points, which is 6 cents on every $100 per year. Over the last 10 years, VYM has historically returned around 10.9% annualized, which is roughly 150 basis points below SEHD, and yet it has done it across about 589 holdings, which is almost 6 times the diversification SEHD offers. The reason VYM stays out of the spotlight is brutal in its simplicity. Vanguard does no paid advertising. There is no influencer budget, there is no campaign, and so the fund just sits there, compounding while everyone else competes for the dividend audience. Item number 2, DGRO, the iShares Core Dividend Growth ETF. Launched in June of 2014, which means it has just crossed the 11-year mark, And over the last decade, it has historically returned about 13.01% annualized. That number matters because it is meaningfully ahead of SAHD over the same window, and yet DGRO almost never appears in the recommendations from the loud channels. It holds about $38 billion in assets. The expense ratio is 8 basis points. It owns 445 companies that have grown their dividends for at least 5 consecutive years, which is a very different filter from the high-yield filter VYM uses. In 2022, when SHD held up reasonably well and the broader market fell about 18%, DGRO declined about 7.9%, which was a much shallower drawdown than the index. The reason DGRO sits in the shadows is that the iShares lineup is so deep that DGRO competes for attention against IVV, ITOT, and IEMG, and the marketing team has never picked dividend growth as a flagship story. The result is a fund with the highest confirmed 10-year total return on this list outside of one other name, and a brand awareness that punches well below its weight. Imagine you had put $25,000 into DGRO at the start of 2015. Based on the historical compounding rate, that position could potentially have grown to roughly $76,000 by the end of 2024 before any new contributions. That is exactly the math SEHD claims to deliver, and very few people noticed. Item number 3, HDV, the iShares Core High Dividend ETF. This is the one most dividend investors have heard of, and almost no dividend investor actually owns. HDV launched in March of 2011, holds somewhere in the $12 to $13 billion range, and currently yields around 3%. The expense ratio is 8 basis points. The methodology screens for companies with both an economic moat and the cash flow to cover the dividend, which sounds like SEHD on paper. But the holdings end up tilted heavily toward energy and defensive names. That tilt is the reason HDV underperformed during the 2019 to 2021 tech rally. It also helps explain why HDV held up better than the broad market in 2022 when the energy sector was one of the only places the dividends actually grew. HDV gets skipped because the iShares brand uses it as a defensive complement to its growth funds rather than a flagship dividend fund. Whether you want a defensive yield tilt depends entirely on what the rest of your portfolio already holds. Item number 4, PEA, the Invesco High Yield Dividend Achievers ETF. Launched in December of 2004, which means PE has lived through the housing crisis, the dot-com hangover, the great financial crisis, and every drawdown since. The methodology deselects 50 stocks with the highest trailing 12-month yield from the NASDAQ Dividend Achievers Index, which is a roster of companies that have raised their dividend for 10 consecutive years or more. That is a punchier filter than SEHD uses, but it is also a more dangerous one. A pure yield rank with no quality overlay can drift toward yield traps when interest rates spike, because the highest yielders are often the most stressed. Harry once asked me why PE does not get more attention given the survivorship. And the honest answer is that Invesco does not spend marketing dollars on PE because it spends those dollars on QQQ. The result is a fund older than the iPhone, with a strategy that has historically worked and a recognition factor that hovers near zero in dividend comment sections. Item number 5, FVD, the First Trust Value Line Dividend ETF. FVD launched in August of 2003, which makes it one of the oldest dividend ETFs alive, and yet it is so far off the retail radar that most investors do not know which family of fund runs it. The methodology is the part that matters. FVD only holds stocks that earn the top 2 ranks on the Value Line safety scale, and then it equal weights every position rather than market cap weighting them. The equal weighting reduces tech tilt, which is a polite way of saying it caps the upside during growth rallies. But it also reduces volatility, which is the entire point of buying a fund whose name has the words value and safety in it. FVD slips through the cracks because First Trust is not a household name, the Value Line brand has aged out of retail recognition, and equal weighting produces returns that look like nothing in particular until you look at the drawdown chart and realize that flat is what you wanted. Investors who held FVD through the worst of 2008 and again through 2022 have a chart that does not look exciting on any single day. And that is precisely the kind of investing the loud channels cannot package into a thumbnail. Item number 6, DJD, the Invesco Dow Jones Industrial Averages Dividend ETF. DJD launched in December of 2015 and owns exactly 30 companies. Those companies are the same 30 companies in the Dow Jones Industrial Average, but DJD weights them by dividend yield rather than by share price. That single methodology choice is what makes DJD strange. You are buying the most prestigious 30 large-cap names in the United States, with a forced tilt toward whichever ones currently pay the highest yield. The fund has the smallest assets of any name in Chapter 1, which is a function of the fact that retail investors who want Dow exposure buy DA, and Invesco has never marketed DJD as anything other than a niche cousin. There is a case for DJD when the rest of the market looks expensive, because the Dow is concentrated in companies that have already survived their growth phase. But it is also the case that 30 companies is not enough diversification for a portfolio anchor, which is why DJD almost never makes the recommendation list. 6 down. If you have made it this far, you already know more about quiet dividend ETFs than almost anyone scrolling past dividend videos in 2026. The foundational 6 were the obvious ones, the ones experienced investors expect. But the next 6 are where this video gets interesting. These are the funds that exist somewhere between obscure and forgotten. One of them is run by an asset manager with 76 years of mutual fund history, but its ETF wrapper is so new most retail investors still call it by the wrong ticker. Another one pays a yield close to 3.5% on companies based entirely outside the United States, and it has compounded at almost 13% over the last 5 years. Stay with me. The quiet ones get louder from here. Chapter 2. The Hidden 6. The funds in this chapter share a single feature. The asset managers who run them have not made them flagship products, which means the marketing budget never showed up, which means the funds compound while the loud funds eat the airtime. 2 of them are too young for a 10-year track record, but have already started outperforming on shorter windows. 2 of them invest entirely outside the United States. And one of them does something so methodologically odd that it could either be brilliant or structurally broken, depending on what happens in the next credit cycle. Item number 7. SDG, the ALP Sector Dividend Dogs ETF. SDOG launched in June of 2012 and runs the classic dogs of the Dow strategy across every sector of the S&P 500 at once. The methodology picks the 5 highest yielding stocks from each of 10 sectors, then equal weights them. That single design choice is what makes SDOG genuinely different from every other fund on this list. Equal weighting across sectors means SDDOG cannot get over-concentrated in energy when energy is paying the highest yields, and it cannot get over-concentrated in tech when tech is the only thing rallying. The trade-off is that SDOG always holds the bruised names in every sector, by definition, which means it has periods where every position in the portfolio looks broken at the same time. The DOG strategy has been studied since the 1990s, and the academic record is mixed at best. SDOG falls off the recommendation lists because ALPS is a small ETF provider with almost no retail marketing budget, because the DOG's concept fell out of fashion sometime after 2010, and because the equal weighting drag during a tech rally is the kind of thing that makes a fund disappear from the rankings even when the underlying strategy is sound. Investors who can sit through 3 to 5 year stretches of relative underperformance can occasionally be rewarded when value rotates back, but very few investors can actually sit through that without selling. Item number 8. RDIV, the Invesco S&P Ultra Dividend Revenue ETF. RDIV launched in September of 2013 and weights its holdings by revenue rather than market cap. That sounds like a footnote, but the consequence is dramatic. Revenue weighting tilts the fund toward the largest businesses by sales volume, which means RDIV ends up overweight in legacy industrials and consumer staples, and underweight in software and high-margin services. RDIV holds about 60 positions. The fund has had stretches of strong performance and stretches of brutal underperformance, depending entirely on whether the value or growth side of the market was leading. RDIV gets skipped because revenue weighting is a concept almost no retail investor can explain, and Invesco has never tried very hard to explain it. It is the kind of fund that sits there waiting for value to come back into favor, and the question for an investor is whether you have the patience to wait with it. The honest answer for most people is no, which is exactly why the fund exists in the form it does. Item number 9. DIVB, the iShares US Dividend and Buyback ETF. DIVB launched in April of 2017, which means it is too young for a full 10-year track record, but old enough to have lived through 2020 and 2022. The methodology is the part that matters. DIVB combines traditional dividends with share buyback yield, which is the rate at which companies are buying back their own stock and reducing the share count. That is a structurally different definition of shareholder return, because a buyback returns capital just as effectively as a dividend, but it does it tax-free until you sell. SHD ignores buybacks entirely. So does VYM, so does DDRO. DB is the only fund on this list that actively screens for it. The reason DIVB stays in the shadows is that the buyback story requires a full sentence of explanation, and YouTube hooks do not have time for a full sentence of explanation. But for an investor who is taxed on dividends in a brokerage account, the buyback overlay is a meaningfully different piece of the total return equation. Item number 10, CGDV, the Capital Group Dividend Value ETF. This is the fund Harry kept asking me about for a year before he understood what it was. CGDV launched in February of 2022 as an ETF, which is brand new, but the underlying strategy is older. Capital Group has run the same approach as a mutual fund under the ticker CDVAX for years, and the ETF wrapper is just a new package for an existing engine. The fund is actively managed, which puts it in the minority on this list, and the asset manager behind it is the firm that runs American Funds, which has 76 years of mutual fund history. Over the last 3 years through early 2025, CGDV historically returned about 12.1% annualized, which placed it in the top 1% of Morningstar's U.S. value category. The fund has not yet hit a 10-year history as an ETF, so it cannot pass the strict 10-year rule we set at the top. But the underlying engine has a track record that outperforms most of the index-based competition on a risk-adjusted basis. CGDV stays off the major recommendation lists because Capital Group has historically been a fee-paid mutual fund company, and the ETF rollout is recent enough that retail investors still call it buy the wrong ticker. The honest case for CGDV is that it is the rare actively managed dividend fund whose expense ratio sits low enough not to disqualify itself before the math begins. Item number 11. SKY, the Schwab International Dividend Equity ETF. SKY launched in October of 2021 and holds about $2.2 billion in assets. The trailing yield sits around 3.4%. The expense ratio is 8 basis points, which is identical to SEHD's expense ratio. The reason SKY exists is that Schwab decided to take the methodology that made SEHD a household name and apply it to non-US dividend stocks. The result is a fund that screens for international dividend growers using the same kind of quality filters SEHD uses on US names. Since inception, SKY has returned about 8.99% annualized, which is respectable for a fund that launched into a brutal international value drawdown. SKY gets passed over for a reason that is almost philosophical. American retail investors have a documented home bias, which is a polite term for the fact that most people refuse to invest outside their own country. Schwab does not heavily promote SKY because the audience is not actively looking for it. But for an investor who already owns the US side, SKY is the simplest possible way to diversify without leaving the Schwab wrapper. Item number 12, VYMI, the Vanguard International High Dividend Yield ETF. VYMI is the international cousin to VYM, and it has been around since March of 2016. The fund holds about $19 billion in assets and yields around 3.5%. Over the last 10 years, VYMI has historically returned about 10.95% annualized, which is roughly the same as VYM, and yet VYMI invests entirely outside the United States. The 5-year return number is even more interesting, somewhere in the 12.6 to 12.8% range, which means international high dividend stocks have been compounding faster than the U.S. high dividend basket over the most recent half-decade. In 2022, VYMI declined about 7%, which was meaningfully shallower than the U.S. broad market. The fund slides off the spotlight because international ETFs are perpetually out of favor with U.S. retail investors, because Vanguard does no paid advertising, and because almost every dividend creator focuses on U.S. funds by default. The longer-term case for VYMI is that holding both VYM and VYMI together gives you something close to a global high-dividend portfolio at a blended expense ratio of less than 10 basis points, which is a structurally different cost basis from what an actively managed international fund would charge. Now we move into the part where this kind of investing gets dangerous. The next 4 ETFs look like the others on paper, but 2 of them are quietly different in ways that can wreck a retirement portfolio if you miss the fine print. One of them holds an asset class that uses regulatory leverage by design, meaning when credit stress hits, the dividend can collapse in a single quarter. Another one writes options against the S&P 500 and reports a yield number that almost everyone reads wrong. I have watched investors pile into both of these because the headline numbers looked friendly. The headline numbers are not the story. By the end of this chapter, you will know exactly which 2 of these 18 funds belong in a portfolio and which 2 belong on a watch list. Chapter 3. The Specialty 6. These are the funds that do something different enough from a standard dividend fund that they earn their own chapter. Two of them generate income from options. Two of them sit in Wisdom Tree's lineup, which is a brand that almost no retail investor recognizes. One of them is the most dangerous fund on this entire list, and we will get to it carefully. The last one is the climactic pick, and I will make the case for it in detail at the end. Item number 13, SPY, the NEOS S&P 500 High Income ETF. SPY launched in August of 2022 and holds about $9.5 billion in assets. The expense ratio is 68 basis points, which is meaningfully higher than the funds we covered in Chapter 1, and that fee level matters because SPY fails our 40 basis point cost rule before the math even starts. The structure is what makes SPY specialty. The fund holds the S&P 500 index and writes options against it using a combination of flex options and equity-linked notes. That options overlay is what generates the income, which means SPY's yield is not a dividend yield in the traditional sense. It is an options premium yield distributed monthly, and a meaningful portion of it can come back as return of capital depending on how the underlying contracts settle. The headline yield reported on retail platforms varies depending on which calculation method they use, and the gap between the I-price yield and the distribution yield is large enough that it confuses almost everyone who reads it. SPY is specialty because NEOS is a small focused ETF provider, because options-based income is poorly understood by retail investors, and because the fund launched into a bear market that suppressed early adoption. The trade-off for retirees is straightforward. SPY may deliver more current income than a traditional dividend fund, but it does so by capping upside and accepting return of capital classification in the tax wrapper, both of which are not trivial. Number 14, DEVO, the Amplify CWP Enhanced Dividend Income ETF. DEVO launched in December of 2016 and holds about $7 billion in assets. The trailing yield sits around 5%, which is meaningfully higher than the rest of Chapter 1 and Chapter 2. The expense ratio is 56 basis points, which also fails our 40 basis point cost rule. DEVO holds about 34 large-cap dividend growers and selectively writes covered calls against the positions to generate additional income. The covered call overlay is the part that matters. Covered calls cap the upside on the underlying positions, which means DEVO will underperform a pure dividend fund during strong bull markets, and it will outperform during sideways and mildly negative markets. The fund is actively managed, which gives the manager discretion to stop writing calls when conditions are wrong, but that same discretion is also a single point of failure. DEVO gets dismissed because Amplify is a small ETF provider, because the fee level triggers immediate dismissal from cost-conscious investors, and because covered call mechanics are poorly understood even among investors who have owned the fund for years. Item number 15, KBWD, the Invesco KBW High Dividend Yield Financial ETF. We need to pause here. KBWD is the most dangerous fund on this list, and the conversation has to be careful. KBWD launched in December of 2010 and invests exclusively in the financial sector, with heavy allocations to business development companies, mortgage real estate investment trusts, banks, and insurance carriers. The fund is selected for high yield, and the headline number is genuinely large. But that yield comes from a specific and risk-laden corner of the market. Business development companies use regulatory leverage by design. Under the Investment Company Act, BDCs can take on debt up to 1-to-1 against their equity, which is a structurally leveraged position, even though KBWD itself is not a leveraged ETF. When credit stress hits, BDCs frequently cut their distributions, and KBWD has historically experienced distribution cuts during exactly those credit stress windows. In 2020, when the pandemic hit the credit markets, the financial sector took an unusually severe drawdown, and KBWD's underlying holdings were directly in the path of it. The fund is specialty because the structural leverage is hidden inside the underlying holdings rather than disclosed on the surface, because the headline yield masks the dividend cut risk, and because almost no retail investor reads the BDC leverage disclosures before buying. KBWD is on this list as a cautionary item, not a recommendation, and it is the reason the Chapter 3 intro warned that 2 of these funds belong on a watch list, 3 away from the most important one. The last item on this list is the only fund in all 18 that required every single one of its holdings to have raised its dividend for 25 consecutive years. Through the dot-com crash, through the great financial crisis, through the pandemic, through the 2022 rate shock that broke half of the bond market, When the S&P 500 fell about 18% in 2022, the climactic pick fell roughly 7 percentage points less than that, and it did it without changing a single rule in its methodology. If you only own one of these 18 quiet dividend ETFs, the case for it gets harder to argue against the closer we get. Item 18 is coming. Stay with me. Item number 16, DLN, the Wisdom Tree Large Cap Dividend ETF. DLN launched in June of 2006, which is one of the oldest inception dates on this list, and yet the fund sits in a peculiar position inside Wisdom Tree's own lineup. DLN uses a dividend stream weighting methodology, which means it weights stocks by the dollars of dividends they actually pay, rather than by market capitalization or by yield rank. The result is a fund that looks like a market cap weighted US large cap index, but where every position is filtered to dividend payers. DLN sits in the shadow of its own sibling because Wisdom Tree's own DGRW has eaten the brand attention, because dividend stream weighting feels methodologically plain compared to the quality growth narrative DGRW carries, and because Wisdom Tree is a second-tier provider with no advertising spend to fight for retail mindshare. DLN is not a top recommendation on this list because the methodology produces returns that essentially track a broad large-cap dividend index with no meaningful tilt that would make it preferable to a cheaper alternative. Item number 17, DGRW, the Wisdom Tree US Quality Dividend Growth ETF. DGRW launched in May of 2013, and over the last 10 years, it has historically returned about 13.94% annualized on a net asset value basis. That number is the highest confirmed 10-year return on this entire list, including SEHD and including every Chapter 1 fund. The methodology is the part that matters. DGRW screens for companies with high return on equity, high return on assets, and positive earnings growth forecasts. And then it weights the holdings by the dollar value of the dividends those companies pay. That combination tilts DGRW toward profitable companies whose dividends are growing in absolute dollar terms, which is a very different filter from a high-yield filter. The result is a portfolio that captures profitable tech dividend growers like Microsoft, Apple, and Visa at meaningful weights, alongside traditional dividend payers in consumer staples and industrials. Over 5 years, DGRW has historically returned about 11.92% annualized. Over 3 years, it has historically returned about 15.82%. Over the past year, the fund returned about 22.63%. The case for DGRW instead of SEHD is the case for owning the highest quality dividend growers in the United States without filtering out the technology sector. The math, as it stands today, is that DGRW's 10-year track record exceeds SEHD's by roughly 156 basis points annualized. Compounded over a working career, that gap could meaningfully change the final portfolio value. A dollar invested at the start of 2014 would historically have ended 2023 at roughly $3.70 in DGRW against roughly $3.20 in SEHD before any new contributions. That gap looks small in a single year and becomes the entire story over a 30-year horizon. The risk is symmetric. A prolonged period of growth stock mean reversion, similar to what the market lived through in 2022, would reverse DGRW's lead and put SEHD back ahead. SEHD's higher starting yield also provides more current income cushion during sideways markets, which is a real consideration for investors closer to retirement. DGRW is the second highest conviction recommendation on this list, sitting just behind the climactic pick. It is the fund I would name if a viewer asked me which low-recognition ETF has the longest data-validated case against SEHD on a total return basis, and it is the fund I would build a dividend growth sleeve around for an investor under 50 who is still in the accumulation phase. The honest case against DGRW is that the yield is lower than the headline numbers most income investors want to see, and the methodology can underperform during deep value rotations. That trade-off is exactly the trade-off you accept when you choose total return over current income. A DGRW holder in 2008 would have lived through the same drawdown every quality equity fund lived through, somewhere in the 35 to 40% peak to trough range, and the recovery curve would have looked like the broader large cap market rather than the steeper recovery curves of higher beta funds. For an investor who is mentally prepared for that pattern, DGRW behaves more like a high-quality U.S. equity fund with a dividend overlay than a pure income fund. For an investor who needs the dividend to live on, DGRW is the wrong tool. The decision boils down to a single sentence. If your timeline is 15 years or longer and you do not need the cash flow for daily spending, DGRW historically rewards the patience. If your timeline is shorter, but the dividends fund your groceries next month, the higher current yield of a fund like SEHD or HDV gives you something DGRW structurally cannot. The fund's biggest weakness is also its biggest strength, which is that the dividend dollar weighting concentrates the portfolio in the most profitable dividend payers in the country. And concentration in profitable companies tends to compound until something macroeconomic forces a reset. That reset, when it comes, is when the DGRW investor finds out whether the methodology actually held up. Item number 18. NOBL, the ProShares S&P 500 Dividend Aristocrats ETF. This is the climactic pick, and the case for it is the case for the entire video. NOBL launched in October of 2013 and holds about $12 billion in assets. The trailing yield is around 1.94%. The expense ratio is 35 basis points, which is meaningfully higher than the Chapter 1 foundational funds, but well inside our 40 basis point ceiling. The methodology is the part that earns the climactic pick. NOBL holds exactly the companies that have raised their dividend for 25 consecutive years or more. That single rule is the strictest screen in the entire dividend universe. To make it into NOBL, a company had to raise its dividend through 1987's October crash, through the savings and loan crisis, through the dot-com bust, through the great financial crisis of 2008, through the 2015 energy collapse, through 2020's pandemic shutdown, and through the 2022 rate shock that broke half of the bond market. Every other fund on this list uses some combination of yield, quality, or methodology screens. NOBL uses time. 25 consecutive years of dividend increases is a brutal filter, and the companies that survive it are, by definition, the kind of business that maintain dividend discipline through every meaningful stress test the modern market has produced. In 2022, when the S&P 500 fell about 18.2%, NOBL outperformed the index by approximately 7 percentage points. An investor who held NOBL instead of the broad market in that year could potentially have ended up with a portfolio worth roughly $7,000 more on every $100,000 of starting capital before dividends. That kind of downside protection compounds in ways that do not show up on a one-year chart. Across 3 full market cycles, the difference between owning the broad index and owning a fund whose holdings are constitutionally committed to dividend defense is the kind of edge that decides whether a retirement portfolio reaches the finish line on time. The reason this kind of fund stays quiet is methodologically perverse. Its yield looks small to income seekers. Its expense ratio looks expensive compared to a 0.06 VYM. Its value lives in downside protection, which is the kind of value that does not make viral content during a bull market. But over a full cycle, the discipline of owning only companies that have proven their willingness to defend the dividend across multiple recessions is the kind of edge that compounds steadily until it does not. Harry's father held a portfolio of dividend aristocrat stocks for 30 years before passing it down, and the lesson Harry learned from sorting through that portfolio is that the boring quality of the underlying holdings was not the bug, it was the point. The portfolio did not look exciting in any given year. It looked indispensable across 3 decades. NOBL is the synthesis answer. If you only own one of these 18 dividend ETFs, the case for NOBL is that it absorbs every other fund's strengths into a single rule. It is more diversified than HDV. It is more disciplined than DGRO. It carries less concentration risk than DLN. It does not depend on option structures like SPI or DEVO. It has no buyback overlay confusion like DVB. It does not have the international diversification of SHQI or VYMI, which is the one legitimate trade-off, and the answer for most US investors is to own NOBL as the core and use one of the international funds as a satellite. NOBL has the longest stress-tested dividend discipline of any holding methodology on this entire list, and that is why it is the pick at item 18. So here is the synthesis. Of the 18 dividend ETFs in this video, 6 survived all 3 rules cleanly. Those 6 are DGRO, DGRW, VYM, VYMI, NOBL, and HDV, with the recognition that a few of those passes rely on the most recently available data, and 3 of the 6 numbers require Morningstar verification before the final portfolio decision. 6 failed on either the 10-year track record, the expense ratio, or the assets under management. Those 6 are SKY, CGDV, DEVO SKY, KBWD, and DLN, although the case for SKY and CGDV is essentially that they are too young to qualify, not that they are bad funds. And the final 6, including PFVD, DJD, SDOG, RDV, and DB, are pending Morningstar verification before a clean call can be made. The single highest conviction pick is NOBL, Because the 25-year dividend discipline is a structural edge that no other fund on this list replicates. The second highest conviction pick is DGRW, because the 10-year total return is the strongest confirmed number on this list, and the methodology is the closest thing to SEHD with the technology sector left in. The case I keep making, video after video, is that quiet investing is the only kind that survives a full cycle, because the loud investing strategies always reset when the cycle turns, and the patient ones simply compound through the reset. If you are watching this and you already own one of the 18,